move forward and take the discussion on markets and investing. Our special guest is here with me, joining in from his home, Mr. Nitin Jain. Nitin, of course, is a veteran, has built the business, the side of the business of Edelweiss, which houses wealth management, alternatives, asset management, global asset management, deals with, of course, big family offices as well as ultra HNI family individuals as well across the country. So we thought of getting you an all-rounded view of what's happening on that side. Nitin, thank you very much for your time. Good afternoon. Let's start by understanding your thoughts on the entire investing landscape and the setup between the economy and the market. Is there a connect, as some would like to believe? Markets are rallying ahead to 9,500, but the fundamentals are weak, the macros are weak, the GDP numbers quarterly are expected today. How are you analyzing this macro setup and within that the market?
First of all, Ajay, congratulations. I just heard that you guys have been, you have retained #1 position. So awesome job done there. And a very good afternoon to all of your viewers. As you rightly said, Ajay, I think a lot of us are grappling with this issue, right? Because this kind of a crisis is unprecedented, absolutely a black swan, because I don't think any of us market participants, regulators, governments globally have any history of dealing with such a crisis. Or even if you want to go back and read, it's very difficult to find a parallel. The only parallel that one can probably say is Spanish flu. And there is very little documented history around, especially around economic data of those times. So nobody really has a playbook to project and to decide what path is probably going to be the best. So a lot of decisions are being taken, and they would be modified as and when you start to see the outcomes. But just coming back to what you asked me, the de-link between the economy and the markets. So I think when I talk to all the economic commentators, the general consensus that we are all coming to is definitely that the world is going through a contraction. Earlier, I think there were some people who believed that India might just escape with a slight positive, maybe 0-1% kind of a positive growth. But I think the extension of the lockdown and the way the curve has still not got really flattened out in the country has taken that expectation out. And most of the people now believe that the general or the average consensus around the GDP for the year is going to be probably around 5% negative. I hope we limit our damage to that or slightly below. If that's the case, I think we are still in reasonable shape. But just if you think about 5% negative GDP, and in the beginning of the year, you were thinking about a plus 5% GDP. So that's a 10% swing, and 10% swing of a 200 lakh crore GDP is 20 lakh crore loss, right? This 20 lakh crore loss is real. So it's not something that you can wish away. So this has to be now basically split across 4 key stakeholders, as I put it: the government, the financial sector, the corporate sector.
Nitin, I'm sorry, I'll have to interrupt you just for a moment and I will get your reaction also on that. Move forward and take the discussion on markets and investing. Our special guest is here with me, joining in from his home, Mr. Nitin Jain. Nitin, of course, is a veteran, has built the business, the side of the business of Edelweiss, which houses wealth management, alternatives, asset management, global asset management, deals with, of course, big family offices as well as ultra HNI family individuals as well across the country. So we thought of getting you an all-rounded view of what's happening on that side. Nitin, thank you very much for your time. Good afternoon. Let's start by understanding your thoughts on the entire investing landscape and the setup between the economy and the market. Is there a connect, as some would like to believe? Markets are rallying ahead to 9,500, but the fundamentals are weak, the macros are weak, the GDP numbers quarterly are expected today. How are you analyzing this macro setup and within that the market?
First of all, Ajay, congratulations. I just heard that you guys have been, you have retained #1 position. So awesome job done there. And a very good afternoon to all of your viewers. As you rightly said, Ajay, I think a lot of us are grappling with this issue, right? Because this kind of a crisis is unprecedented, absolutely a black swan, because I don't think any of us market participants, regulators, governments globally have any history of dealing with such a crisis. Or even if you want to go back and read, it's very difficult to find a parallel. The only parallel that one can probably say is Spanish flu, and there is very little documented history around, especially around economic data of those times. So nobody really has a playbook to project and to decide what path is probably going to be the best. So a lot of decisions are being taken, and they would be modified as and when you start to see the outcomes. But just coming back to what you asked me, the de-link between the economy and the markets. I think when I talk to all the economic commentators, the general consensus that we are all coming to is definitely that the world is going through a contraction. Earlier, I think there were some people who believed that India might just escape with a slight positive, maybe 0-1% kind of a positive growth. But I think the extension of the lockdown and the way the curve has still not got really flattened out in the country has taken that expectation out. And most of the people now believe that the general or the average consensus around the GDP for the year is going to be probably around 5% negative. I hope we limit our damage to that or slightly below. If that's the case, I think we are still in reasonable shape. But just if you think about 5% negative GDP, and in the beginning of the year, you were thinking about a plus 5% GDP. So that's a 10% swing. And 10% swing of a 200 lakh crore GDP is 20 lakh crore loss, right? This 20 lakh crore loss is real. So it's not something that you can wish away. So this has to be now basically split across 4 key stakeholders, as I put it: the government, the financial sector, the corporate sector.
Nitin, I'm sorry, I'll have to interrupt you just for a moment, and I will get your reaction also on that. There's some breaking news which is coming in right now from New Delhi, from the ministry. Some commentary has come in. I'll just get back to you in a minute. My colleague Ruchi is here, who's gathering a lot of inputs from the ministry regarding FPI investments into the country from China, which became a bit of an issue, and also about some hints of more stimulus coming in. Ruchi, tell us what all details are you gathering?
Ajay, hi. We're given to understand that even though there is a lot of speculation that the government as well as the RBI are in talks for monetization of the government's debt at a time like this, when the government is already strained in terms of their revenues as well as disinvestment proceeds, we're given to understand that the government so far has not taken any call on the monetization of debt. We're also given to understand that the government believes that at this point of time, their focus should be on how to provide relief to various sectors of the economy after the first kind of relief measures that were provided by the government as well, and for which the government is keeping all their options open for some more support that could be needed in the future as well, in terms of when the lockdown reopens, what kind of a support is needed for the other sectors. I'm also given to understand that the government is actively looking at bringing their cost of borrowing also down, because they are strained in terms of their expenses, and which is one of the reasons that the government recently has scrapped the RBI taxable bonds as well. Also, another important issue on which we now have clarity. Remember, it was only last month that the government had put the FDI route under government approval route, for in terms of all the FDI that was coming in for China. But as far as the foreign portfolio investments are concerned, there is no call on FDIs from China to come under government route just yet. On the other issue of, whether the government is actively considering a bad bank, it is important to note that the government is in active discussions with various stakeholders on whether a bad bank needs to be formed at this point of time or not. However, at this point of time, there is no call that has been taken on that issue. Having said that, now that we're seeing the economy opening up for various sectors, starting to rework, about 25 to 35% of manufacturing activity in the government has already started happening. However, there is labor shortage that is expected to impact the economy quite significantly. Another important issue that we're given to understand that the government is actively watching out for at this point of time is the number of job losses that we have seen in the economy. Ever since the 50-day lockdown was announced by Prime Minister Narendra Modi, we're given to understand that Finance Ministry is in active consultation with the Labour Ministry on the issue of job losses. They're engaging with Labour Ministry, and the Finance Ministry is aware of the fact that this is a difficult situation for an employer to pay their employees at a time when this lockdown has halted the operations for a lot of these firms and enterprises. They understand it's a tough situation, and going forward, we understand that on this particular issue, Finance Ministry and Labour Ministry are in close consultations. So basically, Finance Ministry is watching out for various sectors in the economy at this point of time that would need their support on critical issues like debt monetization, on the issue of FPIs from China being brought under the government route. Those calls are yet to be taken. The call on bad bank yet to be taken. But one thing is for sure, that after the previous package that was announced by the government is keeping all their options open in terms of what needs to be done. And having said that, there was also a lot of talk about what will the government do to push the economy. The government is of the view that demand will have to be induced at various levels while handling taxation. This is an important tool coming in just ahead of the next GST Council meeting that is scheduled for mid-June.
Thanks very much for that, Rishi Bhatia, there filling in after her conversation from the ministry sources. Thank you very much for that. But very interesting inputs coming in. Nitin, you were speaking about the gap which has got in the economy, which would be coming in because of the stimulus. And now Ruchi, my colleague, filling in that the government is not averse to further help to the economy in order to induce more demand. Tie it with the hypothesis which you are actually building in, and what's your reaction to this?
I think despite all the criticism that the government has got in the last one and a half month, I think they are doing something reasonably smart, because they are not stopping with a one big bang kind of a package, and they're taking incremental steps and are very open to the suggestions and the feedback. So which is what I was trying to say, that there is a 20 lakh crore real loss to the economy. I mean, it's just like normal P&L of let's say any corporate. It's at the economy level that you're losing 20 lakh crores. How do you fill that gap? And I think as a combination of what the government can take by measures of stimulus or by monetizing debt, basically taking up upfronting the expenditure from the future, I think that will be a critical part of this. And we have to ensure, and I think your colleague also pointed out, government is thinking in that direction, that households don't take too much of a damage, because the weakest balance sheet amongst these four is actually the households. So in the process, if we end up losing a lot of jobs, and the general the sense of despair that comes in the general crowd, that will pull back demand in a sustainable way, which will make it very, very difficult for the economy to come back. And hence, my bias would be to take a lot more of these hits on either the government balance sheet, share it with the financial sector, share it with the corporate sector. There is no way we can get away with this. It has to be shared, because this is real loss of income. But how you do that, I think how the split happens, we have to be very thoughtful about it and ensure that as far as possible, we protect the household's balance sheet. Yeah, coming back to the markets, I think, Ajay, you also asked me about markets. I think markets went through the phase of complete capitulation, and markets have this habit, they try to project the future, and they try to adjust very, very quickly. So where I come from is that the markets have actually kind of adjusted to the worst case hypothesis very quickly. That was in the period of March and maybe beginning of April. And now as the economy is opening up, market is trying to form a hypothesis, not this year, Because this year is a goner. Everybody knows that this year is going to be a 4 to 5% negative GDP and corporate earnings are going to be very muted. But people are trying to figure out what will happen next year. And one interesting thesis people are building is that though the overall economy is coming down, but there are a handful of companies, especially the leaders in specific sectors, whether it's telecom, whether it's banks, whether even in the sectors which are not doing well, like airlines, the leaders in those segments are going to come back very strongly because the competition is becoming very weak. And hence you will see the indices might not do very badly. Whereas the overall market might still not perform very well, but the overall index, Nifty or Sensex, which basically has the top-notch companies, will continue to do all right. And I think the base there has been formed, maybe another 5 to 10% downside at max is where we see the market. And the upside, of course, everybody is trying to watch as the new data comes in. Ajay.
Right. Nitin, let's break up those points. You said that Street has already priced in, but the government steps on the one hand are to induce demand, but because the lockdown, consumption has been hit. On the other hand, consumption as a space, and we spoke to Nestle also today, one of the leading companies in the consumption space, they are witnessing contraction in demand going forward. Do you see that this actually weighing in on the economy in a big deal, at least in the medium term, 3 to 6 months before some sanity starts coming back? What's corporate India actually factoring in?
No, you are absolutely right. As I said, I think if you look, you have to divide this, let's say pre-Diwali and post-Diwali. Our hypothesis is that Diwali would be probably an inflection point when we will have real signs of whether the demand is coming back or not. At this point, or maybe in the next 3 to 6 months, to imagine a world where demand will be very strong is foolhardy. I mean, it's not going to happen. People are scared of coming out of the house. People are scared of traveling. So how will demand take off? And any demand measure that you take, which is very meaningful, will not really make so much of a difference. What you have to ensure in this period is that the companies are sustaining themselves. The lenders are not calling for bankruptcies on the MSMEs, on the airlines, on the tourism, on the sectors which are very vulnerable. Because if that happens, then you've broken the supply chain. So if you keep the supply chain constant for the time being, and then you bet on the thesis that over a period of time, this curve will flatten, hopefully the vaccine will come in. Even if the vaccine doesn't come in, I'm seeing that globally, I think the response of people has been very positive. People are coming back to normalcy. They're adjusting to real life. I think demand will come back maybe in Q4 of this year. Post-Diwali is when we will watch out for the demand pickup. But as you rightly said, I think most corporates are very sober about the demand expectation for this year. But the leaders in the segments are very clear. This is the year to strengthen the organization, to keep the supply chains intact. And if you're able to do that well this year, then the next year for the companies that are leaders in the segment, it can actually be a brilliant year in that sense.
Right. Nitin, in fact, my consulting editor, Maithili Bhusnurmat, is also here with us, joining us in the conversation. Maithili, there was some breaking news which has just been added by Ruchi from Delhi that Finance Ministry is taking stock of the economy and wants to take additional measures to induce demand, etc. What are your thoughts on that?
Well, I think it's high time the Finance Ministry did do something concrete on that respect, because as we've seen, the stimulus that has been offered by the government so far has been very paltry and is grossly inadequate to meet the demands of the situation. So I think it's important that the Finance Ministry do whatever it can to make up for lost time. I'm not sure that one can really entirely make up for lost time, but it's better that we try at least rather than just allow the opportunity to slip out of our hands.
Environment in which we are operating in, especially from the big money managers across the country, equities are in dire shape. Fixed income also went through a big accident because of the Franklin Templeton issue. Where do you see better risk reward? Do you think the case for fixed income is stronger, or do you think equities look much better on a risk return basis for the next 1 or 2 year basis?
So Ajay, as a house, as a wealth manager, we are very clear that most of the alpha in portfolios is created not by being very bold about making big calls about whether to go into equity, whether to go into fixed income, but making more calibrated asset allocation calls and being very selective about what products you choose to play those asset allocations. But generally speaking, I think there is a very big opportunity in fixed income, which is very counterintuitive to all of us, because you look at the yields and you feel, oh, the yields are very low. I mean, 6.5%, let's say 7% today. I think RBI shut down its window for 7.75% yield paper. That was a 7-year paper. The reality of life is that for the next 2 or 3 years, we are budgeting for a very, very low inflation. And if we are going to go through a contraction, the real interest rates at 7% are very high. And hence, I think if you play duration of, let's say, 4 to 5 years in high quality paper, and we have a product called Bharat Bond, where we raised around 15,000 crores for a lot of PSU firms, which has been a fantastic product for a lot of retail clients. I think it gives you a yield of around 6.8% today for 10 years. I think instruments like those, safe instruments where you're not really taking credit risk, but you're taking some kind of a duration risk, because we believe that structurally the interest rates are going to come down. The yield will be part of the income that you make, but you will also make some capital appreciation. And we have to start looking at fixed income now as yield plus capital appreciation. So there are opportunities, good opportunities in fixed income. Equities, as I said, I think the base has been formed, but you can never allocate more than 25 to 30% of your portfolio in equities on a static basis, right? So it should always be part of the allocation. And we think the downside for equities has got capped. But the upside right now, I mean, it's very, very difficult to guess, because the path that this entire COVID crisis takes is uncertain. But I would not be underweight equity for sure. But this is not the time to really go bold and say, let's go overweight equity. So it'll be a very balanced portfolio. A lot of your portfolio has to be in fixed income. In fact, I have a feeling that even real estate might make a comeback, which again is very contrarian to what people feel, especially the residential part of the real estate. We think commercial might actually now start to not do as well because of all the work from home and the impact on the job losses and all. But we think the residential, because that's been completely broken for the last 7-8 months, that will come back. There's one more thing that I would like to share. I think because we're talking about fixed income, we talked about fixed income. I think there is a big opportunity that I see in the fixed income space that I think people have got disappointed, to be honest, like what you said. About the way the mutual funds have been able to deliver outcomes to clients. In fact, I have a lot of friends there, and we run a mutual fund ourselves. They are great fund managers.
Right.
The orientation of client and looking at things from a client point of view, I feel sometimes we have not done a great job on the mutual fund side. And I think we are seeing a lot of demand from clients to go direct to the bond market. Especially on the high quality papers, there is a lot of activity that has picked up, because people are saying we want to be in control. We don't want to be in a situation where we get stuck in a mutual fund and you put a gate. It's better that we rather buy the paper directly. And you will see a lot more activity in that space from wealth managers in the coming time.
Can I ask you, is there also a case for diversification towards global markets, the way global markets have rebounded so sharply, 30-40% rally in US markets already? You think one should, as an investor, look there as well?
Yeah, I think so, Ajay, because globally, if you see any sophisticated investing population, most people have understood and appreciate the concept of diversification, global diversification very well, right? And that's why you get allocations to emerging markets, European markets, US markets. These are all different asset classes in minds of people. In India, historically, because of capital flows constraints, people were not able to allocate money to global assets. And the growth in India was very, very high. Interest rates in India were very high. And hence, people felt that what is the need to work that much harder and find assets offshore. There are 2 or 3 big themes that have happened. One, I think the LRS has allowed now at least $250,000 USD per person per annum to go out, which is a reasonable size. The second is, I think, some of the mutual funds, including us, have started to provide platforms to access offshore stocks, offshore bonds directly to clients. And what we are witnessing now is a lot of our sophisticated clientele, the family
Right.
of the high net worth and the ultra high net worth, are actually very keen in at least diversifying the 10% of the portfolio into global assets. And we think this will be a trend which will pick momentum. Over a period of time, we think it will become a very common part of a large part of a client's portfolio, maybe
Right.
5 to 15% as global assets.